Good morning, everyone. Thanks for dialing into our Tax Matters webinar. Aim of this is to sort of give you a brief overview of the significant developments of the last few months. This webinar sort of supplements our weekly Tax Flash emails, which are sent out every Thursday afternoon. And if you want to subscribe to Tax Flash, or if you don't get an email and you are subscribed, drop us an email and we'll add you to the mailing list. So your presenters today are myself, I'm Tarek, I'm a senior manager in the VAT team at Keypoint, George Campbell, who's our head of tax, and Raman Ori is our direct tax lead. We want Tax Matters to be as interactive as possible. So for us, it's having a conversation, not just us speaking for 45 minutes. So if you've got any questions, please use the Q&A widget. You should see a widget at the top or at the bottom of your screen. And once we aim to wrap it up in 45 minutes, we'll try and leave some time for questions. So feel free to either post them through the widget or ask afterwards. One of the team members will try and respond to your questions using the widget during the webinar, but we will share a PDF copy of the slides and a summary of the Q&As by the end of tomorrow. So I'm going to kick off by touching on e-invoicing. It's the hot topic at the moment in Saudi anyway. In a nutshell, KSA resident taxpayers have, I think, just over 2.5 months to review their current IT infrastructure, implement any changes required, and then test those changes work correctly. Some of the issues I've been seeing clients have are primarily around invoicing sequencing. I had a call with the business yesterday, and they're having issues because they've got different IT systems, different revenue streams, and they're trying to work out the best way to update the IT infrastructure to ensure they're sort of compliant. Another issue I'm seeing quite commonly is sort of one-off events, the invoicing of one-off events, manual adjustments, which don't usually go through the normal invoicing process. So that's something definitely to think about. Some taxpayers are not sure, I've seen, whether their IT systems meet the tamper-proofing and the user control requirements set out by the e-invoicing regulations. So that's something definitely worth considering, especially if you think that you're already compliant. I've seen cases where, some finance or IT people have thought that QR code requirements start from phase 2, which is 1 January 2023. However, actually, for simplified invoices in Saudi, the QR code requirement starts from 4th of December 2021, from phase 1. And it's just, I think, a general note to just check the quality of the tax data and the logic sort of you guys apply before applying or sort of reporting transactions. That's actually, I think, a really significant point. What I've seen generally is due to sort of time pressures, taxpayers completely disregarding, not out of choice, but because of the time pressure, disregarding phase 2 completely. And actually some of the work that involved in phase 1 and phase 2 is actually pretty much similar. And so normally it would make sense to look from now until the end of next year. So phase 1 and phase 2 as sort of one single journey, rather than having 2 separate journeys. So one for phase 1 and then one for phase 2. It definitely makes more economic sense to have one journey. But like I said, because taxpayers generally or sort of, leave it late, it becomes difficult. What I have seen though, also around sort of, appetite on risk, compared to that implementation, I'm seeing key decision makers, I'm talking about your CFOs or your finance directors, they're seriously considering the risk that e-invoicing poses to their business, more from a tax audit point of view, which I'll talk about in a moment. But in a nutshell, what I've seen is that key decision makers are not very comfortable taking all the risk from the e-invoicing, especially if they miss something, easy out, or if something, needs to be done, and they're not too sure the timescales involved in some of the things and how long it will take. So that's something to think about. Yeah. Okay. Moving on to GSTC rulings, interestingly, the GSTC published some really interesting information covering outcomes of tax cases or rejections of tax cases. Common reasons for rejection included stuff like failure to object to a decision sort of made within the timeline, failure to attend a hearing. I mean, some of the reasons were, I thought, really, like, can that really happen? Surely someone can't miss a deadline. But actually, it's one of the most common reasons for appeals being rejected. So I think for me, there's some important lessons here. Firstly, if you're not 100% familiar with the tax appeal process, I'd speak to someone who's, who knows the process inside out. I think it's fair to say that there are different categories of tax advisors generally operating across any tax jurisdiction. So it's important to ensure the person you're speaking to is comfortable with that litigation process. And half of the appeal work is getting things correct from a procedural perspective. For each appeal I work on personally, I like to run things past my colleagues so they can provide their own experience on sort of aspects where things are either not set in stone or an administrative procedure sort of been updated, because there's updates happening all the time. I know of a couple of businesses very recently, they've tried to appeal tax assessments in-house where there's been no or very little experience. And this was, I'm talking about VAT assessments where the 60-day time limit applies. And what they've done is at the last minute, so I think on day 48 or day 49, they've decided to engage a tax advisor as they've realized they're not comfortable with the level of risk undertaken, both from a personal perspective and from an organizational perspective. Roman, I know I've seen a lot of POA or power of attorney issues where either the power of attorney was not effective or the delegation was not effective from a legal standpoint. What are your thoughts about that?
Thanks, Tariq. It's a very good question. And ZATCA has actually alluded that one of the more common reasons why the appeal committee sides with the ZATCA is because the taxpayer has not drafted the power of attorney correctly. My recommendation to clients would be to seek legal advice, because at the end of the day, the GSTC and appeal committee bodies are quasi-judiciary bodies, and the taxpayers need to make sure that they are fully compliant in terms of the procedural aspects, particularly on the legal side, and therefore they should appoint a lawyer, or at least our recommendation is they should appoint a lawyer to make sure that the POA is well drafted and it covers all the necessary, it has to be issued by the person who has the authority to issue the power of attorney. The power of attorney should be very sort of complete in every respect, so that the lawyer or the tax consultant can represent the client at each level of the litigation process. So those are my 2 minutes thoughts on that, Tariq.
Great, thanks for that, Roman. That was really useful. I'm gonna bring George in and just, if he could maybe set out his thoughts of the GSTC process and the appeal process in Saudi generally, as he was obviously one of the directors of one of the big 4 firms in Saudi until he joined us or rejoined us recently. George, any thoughts from your side?
Yeah, thanks, Tariq. I think the most important thing to note about the GSTC and appeals process and objections is just that word process. It has very defined and clear timelines for, if you are assessed by ZATCA, making an objection, appealing that objection to GSTC. If you are unsuccessful, and then where you go thereafter, defined deadlines, 60 days to appeal your VAT assessment. If you're unsuccessful, 30 days after that to escalate to GSTC. And then you have some options. You could go down the alternative dispute route, which halts the GSTC process. And if you reach a resolution, then that's finalized. If you don't, then you can go effectively back on track to GSTC or even HAC. I think it's an important point to make that you kind of need to be, you really need to have a live appeal lodged at all times. You can't miss deadlines, and things like alternative dispute resolution is only available to you if you have a live appeal. Seeing some of the reasons for rejection at GSTC is not a surprise, but it's disappointing. because adherence to these deadlines is the real critical factor here, as well as things that Raman points out in terms of documentation accuracy, correct POAs, understanding, for example, that unless you have a Saudi lawyer who's got the POA, then your POA can really only represent a maximum of 3 cases. In many instances, awareness of that would have solved, I think, some of these rejections. And certainly the administrative aspects, when we look at things getting rejected for being appealed out of time, late, out of process, out of order, a lot of these they're easy fixes. So for me, the takeaway is that this is a process and it needs to be followed, and then we can come to the technical reasoning behind the objection. Does it have basis? It's litigation at the end of the day, and it needs to be approached appropriately.
Great, thanks, George. George, from your experience, have you seen where the GSTC has rejected an appeal? Is there any further sort of recourse to any other avenue, or is that end of the matter as far as the litigation process goes?
When you get to HAC, Tariq, was that?
No, I'm saying, so for example, a taxpayer, for example, doesn't appeal within the time limit to the GSTC and they miss a deadline. Is there anything they can do after that, or is that really the end of the matter?
The amount of times I've seen procedural aspects strike out a case tells me that if you miss the deadline, you have missed the deadline. It would be like, look, tax authorities worldwide and committees and tribunals can accept an appeal out of time, but that's completely at their discretion. As I say, the amount of times that I've seen something struck out for a procedural failure it's just not worth even coming close to missing the deadline, because it's an easy veto for the ZACA when it comes to actually contesting the matter in court.
Yeah, thanks, George, for that. George, what I've seen, I think generally is where taxpayers have waited till the last day or have delayed things. I think sometimes there's IT issues at the end, and that's really caused problems where, they're on the last day, it's a late afternoon, a Thursday afternoon, and it just causes too many problems. So I think the key takeaway for me is that taxpayers really try and submit well within the time. I'll pass over to you to give some updates on BEPS.
Thanks, Tariq. So my name is Ram Nouri. I head the Key Points Corporate and International Tax Practice for Bahrain and Saudi Arabia. I wouldn't be wrong in saying that the last few months has been nothing short of a revolution when it comes to international tax, globally, as well as particularly relevant for the GCC region, which is a low tax region. Before I get into the details, let me take you back to 2016 when BEPS was first initiated. Historically, domestic tax laws were written to tax multinational businesses in jurisdictions where they had a physical presence. However, as a consequence of globalization and digitalization, it's far more easier now for businesses to sell goods or provide services without actually having a physical presence. The perception amongst the international community was that the multinational entities were exploiting these archaic tax laws and were able to distribute their profits from a jurisdiction in which they would be taxed at a higher rate to a jurisdiction where they would be taxed at a lower rate or even escape tax altogether. This obviously did not sit well amongst policyholders and tax authorities worldwide. Therefore, in response to these challenges, a joint initiative by the Organization for Economic Cooperation and Development, OECD, and the G20 set out a 15-point action plan to tackle these profit attribution issues and also to tax the digital economy. Known as the Base Erosion Profit Shifting Project, BEPS, this has been signed up or has 139 countries. And the overlying objective of these action points is to tackle tax avoidance, create a more harmonious international tax system, and to encourage tax transparency. Bahrain joined this initiative in 2018 and signed up for the 4 minimum action plans. Action 5, which relates to harmful tax practices. Action 6 and 15, which relates to treaty abuse. Action 14, which relates to transfer pricing documentation. And Action 14, which relates to dispute resolution. For the purposes of this morning's webinar, I will be touching upon Action 5 and Action 13 as it's relevant for Bahrain. So what does Action 5 say? Well, Action 5 says that multinational enterprises who are operating in Bahrain and generating profits should have a commercial rationale for doing business. Most of you would be aware that Bahrain introduced the economic substance rules way back in 2019, and this was as a direct result of implementing this action point. Back in 2019, the economic substance was administered by the Ministry of Industry, Commerce and Tourism, the MOICT, and largely the return was pretty straightforward, and there were some exemptions for holding companies and companies that had exclusively operations in Bahrain. However, from 2020, it's now the NBR who has been tasked with the implementation of the economic substance regulations, and they have totally revamped the return. It's now required to be filed online, and there's no more exemptions available. So it's far more complex, and there's a lot of documentation requirements required of the taxpayer. Just as a quick refresher, the relevant activities that are subject to the ES rules are holding companies, head office, management office, shipping agents, leasing of equipment, whether it is office, transportation, or motor vehicle, and intellectual property. The deadline for filing the economic substance return has moved several times. It was originally supposed to be filed by the 31st of March this year. Yesterday, the deadline has been extended to this coming Saturday, the 18th of September. I would hope that most businesses who are subject to the rules have already filed the returns, but if there are any businesses who haven't looked into this, I would strongly recommend to ensure that you file by the deadline. There are some severe consequences for failure to report or failure to file the economic substance return. Namely, the ministry can issue a violation or suspend your CR. The NBR can apply fines, or you can even have your company struck off the commercial register. If businesses would like any support or unsure of their requirements, please feel free to contact one of ePoint's tax team. We'll be happy to help. We now move on to the second action plan that's very relevant and hot topic for Bahrain, and that's transfer pricing documentation. So Action 13 requires multinational enterprises to prepare transfer pricing documentation to support the price that they charge or are charged for goods and services are calculated at market value. Typically, tax authorities require M&Es to prepare 4 pieces of documentation. 1, the group transfer pricing policy. 2, master file. 3, local file. And 4, country by country reporting. For now, Bahrain has implemented just the requirement to file the country by country, that's the CBCR report. There are two aspects to the filing of the CBCR. One is the CBCR notification. Now, transfer pricing the CBCR requirements have come into effect from this year, but are for the financial year 2020. So if your business has a group consolidated revenue of more than Bahraini dinar 342 million, you are required to firstly file a CBC notification by the 31st of December this year, basically informing the NBR as to who will be filing the report, whether it be filed by the parent entity sitting outside of Bahrain, or it could be that the entity in Bahrain has been appointed to file the report on behalf of the parent. The second aspect of that is the actual CBC report itself, and that is required to be filed 12 months from the end of the accounting year ended 31st of December 2021. So effectively 31st of December 22 will be the first filing of the CBCR report. The Ministry or the NBR hasn't released a template as yet. They've been far too busy trying to administer economic substance. But I do expect that they will be, over the next month or so, releasing the template. I would expect the CBCR report to be more in line with OECD requirements, which is basically requires multinational enterprises to provide certain financial data for each of its branches or subunits, wherever they might be doing business in the world. So the data could be, would typically be your profit or loss before tax, revenue, assets employed, number of employees, tax liability, and so on and so forth. So there's a lot of data to go on that report. And it's also crucial for MNEs to be aware that Bahrain has over 50 bilateral relationships with foreign jurisdictions, whereby they are committed to share the CBCR report. So this data that's being provided to the NBR could easily fall into the hands of the tax authority in the parent company's jurisdiction, who will then be able to evaluate and assess how much tax the MNE is paying across the globe. And that, of course, could bring about transfer pricing audits, not only locally, but more so in the parent company's jurisdiction. I think that's it for now. So I will hand back to Tariq, who will continue with the next part of the presentation.
Thanks, Rahman. Okay, so Zakka's recently published a government bodies guide, basically resetting out the concepts of economic activities where they relate to government bodies in Saudi. The guide is relevant for all businesses because, or at least to be aware of the guide, because at any point a supplier might find themselves making supplies to KSA government bodies. Now, it is of particular importance for non-resident businesses where they make supplies to government bodies in KSA. One of the really interesting points is that Zakka's clarified that if a supply to a government body from a non-resident only relates to activities which the government body carries out in their public authority capacity, the non-resident supplier becomes liable to account for VAT in KSA, obviously taking into account the place of supply rules, and accordingly will be obligated to register for VAT. That applies even where the government body is registered for VAT. So practically speaking, it's a pretty tough one. And I say that because if you make a supply to a government body, some things to now think about are how do you prove the government body is purchasing supplies for economic activity or not? And how do you evidence that? What if the government body itself isn't sure? So you have a guy from the procurement team that you're dealing with who's buying XYZ from you. He might not have a clue what the purchase is actually for. So important takeaway here is for businesses really to consider the VAT treatment that they're currently adopting for supplies made to government bodies in KSA, and just to double check that it's in line with the guidance released. And if the VAT treatment adopted is correct, definitely reconsider how you would prove that the supplies are for either economic activity or non-economic activity, and just have a look at from a risk perspective. I'm just going to ask George. George, do you want to touch a bit on government bodies and what your sort of thoughts are on this?
Yeah, this was an interesting one because we have, government bodies registered, some registered for VAT with respect to what they do that would constitute economic activity, and obviously they have other activities which fall within the remit of being a public authority under public duty, which are not economic activities. Now, that registration means certain things for foreign suppliers. Until this kind of clarification, you would have treated them as, under the law, a taxable customer, and that taxable customer would have been required to perform the reverse charge where there had been an effective B2B place of supply shift, and the taxable customer in KSA would be responsible for performing the reverse charge. And that was helpful for a number of reasons. I mean, the reverse charge is almost, an administrative easement that stops foreign suppliers having to unnecessarily register for VAT in a jurisdiction, stops the tax authority having to deal with the administration of their return, etc., etc. But this latest kind of clarification in the guidance is saying that if you are a foreign supplier and you're supplying a public authority, government body, which is still a taxable customer under the law, and then technically you still have the place of supply shift if they are buying that for their non-economic activity, so acting as a public authority in their capacity and duty as a public authority, then you can't reverse charge that, or the government body shouldn't, and therefore you have an obligation for that foreign supplier to register for VAT. It's an interesting one. My only expectation is that it's to pull and give, as with many initiatives at the moment, to pull foreign suppliers into the remit or realm of VAT and have more transparency as to what they're doing in the kingdom. So a really interesting technical change or clarification from my perspective, and really would be concerned. I think these, the large contractors who maybe don't generate a PE or an FE from a VAT perspective, they don't have any residence in kingdom, but they're supplying something that the government is going to use for its governmental purposes, and like you say, it will necessitate that foreign supplier to really understand what its supplies are going to be used for. So yeah, rather interesting, and like you say, of real interest to non-resident suppliers, to government bodies, public authorities.
On behalf of a non-resident supplier, and in summary, Zakka's viewing it as that the electronic interface will be considered as acting in its own name, so as principal, unless the non-resident supplier explicitly refers to as the supplier. So sorry, unless the non-resident supplier is explicitly referred to as the supplier in that supply chain of goods and services, the contractual arrangements, any invoices, receipts generated by the interface must show the non-resident supplier's name. They've also said that electronic interface shouldn't really set the terms and conditions of the supply. So that's really interesting from that perspective. The end result, I guess, here is that Saudi e-commerce platforms dealing with non-resident suppliers will, may fall into being as a principal. So I think in terms of recommendation, this is some really serious stuff depending on what business model clients are operating, and sort of this guidance has very wide-ranging consequences for businesses operating in this space. I'll pass it back to Rahman to talk a little bit about the two-pillar approach for BEPS.
Okay, so continuing with the BEPS theme, one of the sticking points was that there was no international consensus as to how countries around the world would be able to tackle the challenges from the digital economy, which is action point 1. After a number of years of negotiations and lobbying, in July of this year, the OECD released a blueprint to address the tax challenges from the digital economy. This blueprint is commonly known as the two-pillar approach, Pillar 1 and Pillar 2. As of today's date, out of the 139 members who have signed up for the BEPS project, 133 of them have agreed a common ground and accepted this two-pillar approach. Obviously the OECD released a statement in July. There's going to be further discussions, and it is expected that by the end of this year, by October, November this year, the final details will be finalized and implementation expected to happen in early 2023. So what are these two pillars? Well, quite simply, Pillar 1 aims to give the domestic tax jurisdiction the first taxing right on the profit generated from the M&E. So simple example, if an M&E is operating in Bahrain, and for the purpose of this, let's assume that Bahrain has corporate tax, it would have the first right to tax it at the rate that's been written in the tax laws. Previously, obviously, that right could have been with the parent company, or no one could have had the right. But now with this Pillar 1 approach, the domestic tax jurisdiction, quite naturally, because of the fact that the business is operating in Bahrain, is using the resources of Bahrain, i.e. employees, assets, and so on, naturally, it should be given the first right to tax. The second aspect of the Pillar 1 is there will also be a fee that will be calculated for the marketing and distribution activities that the M&E undertakes in Bahrain. Now, the calculation for these amounts, as well as formal approvals, are still ongoing. We do expect that this will be finalized sometime next year to go live in 2023. Pillar 2. Now, this, in my opinion, is going to be a game changer particularly for Bahrain and generally for all jurisdictions that have a low or no tax jurisdiction. What this Pillar 2 says is that it will apply a global minimum tax rate of 15% on M&E's profits anywhere around the world. So again, to give you a very simple example, if an M&E is, say, headquartered in the UK, and the corporate tax rate in the UK is 19%, it has a branch in Bahrain that pays no tax, the M&E will be taxed on the income generated in Bahrain at 15%, even though it's not paying anything in Bahrain, because there is no corporate tax in Bahrain as of now. This pillar basically has two elements to it. One is the global anti-base erosion, commonly called as GloBE, and the subject to tax rule. Now, within the global anti-base erosion, there are two rules: income inclusion under tax payments. To put it very simply, both these achieve the same objective, and that is to collect that top-up tax from the M&E. This tax will be collected by the tax authority in the M&E's jurisdiction. One important point, that the profits that are subject to this tax are the profits generated by the branch in a low tax jurisdiction and not the head office itself. The other one is a subject to tax rule. This is basically to avoid, is a treaty anti-avoidance measure, whereby the local or the domestic tax jurisdiction can have the right to introduce a source-based tax. So again, let's take in Bahrain example. Bahrain can introduce withholding tax. Therefore, any payments that are made by the branch to its parent outside will be subject to withholding tax. And that's another way in which the Bahrain tax authorities can collect the tax under this rule. Okay, final point. The obvious question is, what is Bahrain's going to do? What's the next step? We know that across the GCC, the UAE, Bahrain has no corporate tax. Qatar has a corporate tax of 10%. So these will obviously be impacted by these by the Pillar 2 approach. But even the other countries, for example, Saudi Arabia, that has a headline tax of 20%, and Oman, that has a headline tax of 15%, would also be potentially subject to the rules. Because if you remember, there is also the concept of zakat. So on GCC nationals, zakat is collected at 2.5%. So if an MNE has both GCC ownership and foreign ownership, technically it's possible that the global minimum tax rate, which is an effective rate of tax and is not the same as the corporate tax, could actually be less than 15%. So just something to think about. But coming back to Bahrain, if Bahrain does not do anything, so it does not introduce corporate tax or income inclusion rule, what's going to happen is that, as I mentioned before, the profits generated in this island will be taxed overseas. And the obvious question is going to be, why would the tax authorities, the NBR, be willing to lose out on the tax revenue? And my guess is as good as yours. I mean, I think, there's a very high chance that they will bring in something, at least to tackle this, and so that they can capture the tax from these MNEs. And finally, I think as a key takeaway, in terms of what these businesses, these MNE businesses need to do, I think at the very least, they need to consider a high-level impact assessment of the impact of what these reforms will bring, and maybe even consider budgeting for the cost of the tax, which potentially could be payable should Bahrain introduce corporate tax. That's it on BEPS from my side. Tariq, over to you.
Thanks for that. So yeah, we've got a few questions. Just before I come on to the questions, what I will say from my own experience, especially from that implementation, definitely maybe have a look at your contracts, any documentation internally, arrangements with your suppliers and customers to see if tax is added on or not added on to the final price, because it's caused lots of issues, and even issues to an extent where a profit-making engagement has become a loss-making engagement because they weren't able to add tax on top. So it's just something to think about going forward. I'm just going to have a look at the questions sent through the widget, and we'll try and answer as many as possible. And we'll circulate the questions and answers anyway. So first question I think someone said is, in the generation phase for e-invoicing for December 2021, will I be required to share electronic invoices with Zakka for clearance before issuance? Well, the answer to that is no. That's for phase 2. Phase 1 is just a generation of the e-invoice itself. So your system must be able to generate a valid e-invoice, and there's control requirements and other requirements around that. Got a second question. Someone saying, I'm a VAT registered entity in KSA importing services from non-resident suppliers. And as per the e-invoicing regulations, will I be required to self-generate an e-invoice for reverse charge? George, any comments on that one?
Yeah, no, you won't be. A very straightforward and simple answer. You're not required to generate anything for a reverse charge mechanism reported supply.
Fair enough, George, that was simple indeed. Thanks a lot for that. Okay, and Raman, one for you. What are the consequences if the ES returns are not submitted, and have we seen any penalties being applied, or have you seen any notifications of anything along them lines?
Yeah, good question. In terms of the consequences, I think the ministry, I know the ministry for 2019 in particular, I know the ministry issued a number of violations, but what then happened is the licensee submitted the economic substance return, and those violations were removed. They did not impose any fines. Obviously, it was a challenging time because of the pandemic, and some of these businesses would find it difficult to comply with the rules, particularly in relation to management and control and having board meetings and so on in Bahrain. So there weren't any fines, but the violations were issued and then subsequently removed. For 2020, your guess is as good as mine. It is now with the tax authority, the NBR. We are thankfully nearing to the end of the pandemic. So, they may not take as relaxed a view as the ministry. So it's quite possible. I mean, penalties could range or could be up to a maximum of 100,000 dinars. I think the NBR will probably still give a bit of time to licensees, because this is the first time that they're filing it with them, and there's been a number of changes to the return and the template and so on. So I think businesses should try and file and submit the economic substance return by the 18th of September. If they're obviously not compliant, then they need to justify the reasons why and take corrective measure quickly, so that they don't face any consequences from the NBR.
Great, thanks for that, Rahman. So very quick one on, if a government body owns shares in a private company to undertake activities on behalf of the government body, will the private company be considered as acting in a public authority capacity? So the answer is no. If a government body owns shares of a private company, the VAT rules applied to them would still be the same, they wouldn't change. One for you, Rahman. Saudi-based business subject to corporate tax at 20%, would global minimum tax impact them?
Oh, I wish I had to answer this. It's a difficult one, this, because I think I mentioned this before as well, that the headline tax rate in Saudi is 20%. So you would think, well, why would global minimum tax impact? Because it's only 15%. But we look at the effective rate, and in Saudi, you have the concept of zakat. So if you have a business, a multinational business, which often has both Saudi as well as foreign ownership, the foreign owners would pay corporate tax at 20%. The Saudi shareholders would pay zakat at 2.5%. And it could be that the effective tax rate, which is a different calculation than the standard corporate tax rate, could be below 15%. So if that is the case, then yes, potentially GMT may impact that Saudi business, but this would need to be carefully studied and reviewed.
Great, thanks, Dr. Rahman. I'm gonna jump onto this one because it's one that interests me as well. What immediate steps should Bahrain businesses consider in anticipation of the introduction of corporate tax? Is there anything they can do now, or should they be getting ready to do something?
Certainly, I think there's two things that businesses should consider. One is to maybe undertake a high-level assessment to see what the global minimum tax reform would mean for the business. Secondly, they could perhaps look to budget in anticipation of the introduction of corporate tax. Although that's not a given thing, it probably makes sense and gives them a safety net if they would perhaps budget in a cost for the potential tax payable that to the tax authorities.
Great, thanks. George, one for you, and then I think it's probably going to be the last one. We'll have to, circulate the responses to the other questions. Sorry, we haven't had a chance to cover all of them. Question is, if I'm a disclosed agent supplying goods on behalf of the principal, can the agent issue the tax invoice on behalf of the principal?
Yeah, this comes up. It's been coming up more and more. I think as taxpayers, the authority are getting more sophisticated, but also as I think you pointed out, Tariq, the prevalence of the use of electronic platforms for everything from food delivery to ride hailing. This question of who is acting as principal and who is acting as agent comes up regularly. Look, in a disclosed arrangement, and indeed in undisclosed arrangements, it may be the legal reality, but the principal is supplying the end customer. Now, if you have a clear disclosed agency arrangement, then really the principal should be issuing the tax invoice to the customer. At the end of the day, the person making the supply should be issuing a tax invoice to the person to whom the supply is made. Now, in a disclosed arrangement, if we're looking at truly disclosed agency arrangement, the identities of all parties are known, the supplies made are known, and the supplies made between those parties are also easily identifiable. And so in a disclosed agency arrangement, I would expect to see an invoice generated and issued by the principal to the customer. And the agent, depending on who his customer is, would issue an invoice for the agency services. Quite often that's to the principal. So if we're looking at maybe something sold through a platform where the principal is known, is the one supplying the customer, then you would expect an invoice back from the agent, who's maybe the platform owner, for use of that facility. It's important though and principal agent issues are some of the most complex issues that will arise in VAT, which is already a complex tax. Very important to look at the underlying legal arrangements to really work out, do you have a truly disclosed or undisclosed agent arrangement? Is the principal from an absolute legal and contractual perspective making the supply? And look, you can get into a whole different raft of case law on who is making a supply to whom. But like I say, if we have a truly disclosed agent arrangement, I would expect the principal to be issuing the tax invoice to the customer, with the agent making a supply of purely introductory intermediary services and invoicing accordingly for the required amount.
Thanks for that, George. Really helpful. That's definitely an important topic and one that I'm helping a few clients with. So on that note, guys, that's the end of the webinar. Sorry, we've gone over very slightly. Our next webinar will be on Monday, 11 October. So basically it's the second Monday of each month. And so see you then. We'll circulate all the Q&As and the slides by the end of tomorrow. And goodbye for now. Thank you.
Thanks all.